Well, hello again, everybody. This is Michael Moskal, Director of Investments at MGO. And with me today are Brad Wingler and Justin Petrus. And we are going to talk about today what is at the top of everybody's mind. You see it in the news in the morning, first thing that pops up, and it's the number one question by far right now that we are getting from our clients is the war in Iran. What's going on with the war in Iran? How is it affecting our investments? What's going to happen? So we're going to talk to you a little bit today about our take on that. So Operation Epic Fury, you see the graphic here, the picture. That's the what we named, of course, our attack that we had on Iran that Israel is with us doing, and it has impact in what we're doing. How long has this war been going on, you guys? Has it been? It's
Three
been
weeks,
a
2 weeks, 3 weeks.
it's been a month, isn't it?
Yeah, I think close to a month. Yeah.
Yeah, it seems long. I know it seems like it just started, but it drags on a bit. But it
Hmm.
may be over, maybe heading on to 3 weeks, almost in 4 weeks. We look at this as part of the whole overall deglobalization cycle, which is that middle picture that you see there with the people picking up pieces of the globe and kind of going home. And, we'll talk a little bit more about that today. It's causing a lot of volatility in the stock market. And if you're watching on a daily basis, it's actually not just the stock market, it's the bond market, the gold market, the stock market. It's all kind of markets up and down. And then if things keep going on the way they are, we do see the war pushing up prices, generally speaking, which is inflation. So definitely we're going to see some increase at the pump with gas prices, gasoline prices, which we already have seen that. And also gas prices, meaning natural gas prices, are also going up. There we go. All right, Justin, you want to comment a little bit on this?
Yeah. So let's take a look here at the market scorecard. So this is through 320. So our equity ETF portfolio is down 1.6%, but over the last 12 months, we are up almost 20%. Taking a look at the S&P 500, through 320, it's down almost 5%. The Dow Jones Global ex-US is slightly positive, but pretty much flat. Bloomberg US government credit is down about 0.7%. Looking down at some other indexes here, gold up almost 4% here year to date. Barrel of oil, this is the big one, up almost 71%. Of course, that's going to be directly tied to the supply issues that we're having over in the Middle East. And Bitcoin's down about almost 20% here year to date. But looking over at the last 12 months for some other ones here, gold over the last 12 months up about 50%. Barrel of oil still positive over the last 12 months, almost 42%. And Bitcoin kind of struggling a little bit, down about 24% here over the course of the last 12 months.
Yeah, it's interesting. Equity ETF portfolio, our equity is holding up relative to the stock market, the S&P 500,
Yeah,
pretty
held up
well. I mean, very
exceptionally well.
well.
And
And
same
I
thing with
think,
last year too, with our performance through the end of 2025. We
mhm.
outperformed pretty significantly. We did a great job on that portfolio there last year.
Yeah, and what are some of the holdings in there that we have helping those returns?
So we're gonna have energy. We're gonna have tech in there, obviously. Um, we'll have a variety of different sectors: utilities, communications, materials.
Yeah, it's really helped
International.
in our international, right? Brad, you mentioned international. Because our weighting in international, I think right now is about 33% of the equity ETF portfolio. And that's the highest weighting we've had since 2011. It's been a long time since we've had such a high weighting in international. And that's been that way. We've had it that way for about a year and a half.
Mhm.
And I think, based on what we talk about with investment committee, we're going to continue that weighting and maybe even notch it up a bit, for all kind of reasons that we'll talk about in just a little bit.
And one thing to note here too, with the S&P 500 being down for the year, just to kind of to clarify, usually a few times on average per year, we do see a 5-10% pullback, and that is something that generally does happen a couple times per year. So just having negative numbers isn't necessarily alarming.
Yeah, and that's a very good point, by the way, because we are going to have negative numbers. And Justin, you're right. I think on average, it's about two times a year that we're going to have between a 5 and 10% pullback in stock prices. And once every, what is it, 14 months, 16 months or so, 14 to 16 months, we're going to have a 10 to 20 percenter. When's the last time we had something close to 20%?
Tariffs.
Tariffs, right?
Yeah.
Yep, it was a year
last
ago.
year.
Mhm.
And Justin, you were saying you have people that kind of forgot about that.
hmm Yep, we were talking about performance of 2025. You think back and you kind of explain that, yeah, we did have a huge pullback there in the beginning of the year due to tariffs, and obviously we recovered, and it kind of slipped a lot of people's minds.
Yeah, scratch their heads, say we did.
Mhm.
A 25% or what was it? Market was up 18, almost 18% last year. So people forgot about that blip in the middle of the year where the market where we had the big drop
Mhm.
Yeah,
for
yeah,
sure.
because it was so, on a relative basis, it was pretty quick.
Hmm.
Once tariffs, it was actually going down before tariffs, but once tariffs hit, it was what, about 3, 4 weeks worth of drops. But it was scary because it kept going down every day and the numbers were so big. But, then we had that massive, massive rally from that point in time, starting really in May through the end of the year.
Interestingly, one other quick point on that chart. Sorry to make you go back,
No,
but
that's good.
the drop in gold, it's not really reflected in that chart there. But gold, gold's up 3.8% for the year. But if you go back just a little bit, it was up. It was about 20. It's still about 25% off the high.
Hmm.
So gold has given back a lot of those gains. There's been a lot of speculation in the gold market, I think.
Yeah, and we
So
had,
it's interesting.
we're overweight in gold and silver also. We have silver also. And what we had is they started trading like meme stocks, right, guys? It was, when you started having gold going up 5%, down 4%, up 12%, it was kind of crazy, the activity and the percentage change on a day-to-day basis. And it historically has not been like that. It's a store of value, it's a hedge. It shouldn't be really moving like that. So you did have some speculation, a lot of speculation come into the market. I think in January and early February, like you said, Brad, gold was up close to 30%. Silver was up 65% during just
Yeah.
that month of January. So it's not surprising to see a pullback, but even with the pullback, we're still up for the year.
So
Who's
this
got
is
this one?
an interesting chart, just looking at how the stock market performs historically when you have times of geopolitical tension. In other words, wars and things like that around the world. Um, it's historically when you look at what happens to the markets when that happens is typically you do have a downturn in the market, and that's often somewhere in the 5-10% range. It varies based on the conflict, but literally 75% of the time, if you go out 12 months, um, the market typically is positive 12 months out. So it's not to say that these things are not consequential. They definitely are consequential, but just because you have short-term downturns doesn't mean that the market will stay down for a long period of time. Look at just what's happening in the market today. As we speak, the market had rebounded based on some positive comments from President Trump this morning. Market was up about 1,200 points. I think right now it's up about 700 points as we speak. But um, you know, I you could see a nice rebound in the market at some point. So just be
Yeah,
aware.
and these are scary, so it's definitely when war breaks out or something like this happens, the geopolitical event that happens, whether it's a terror attack or war, it is scary, for sure. And the initial thing when the initial response to some of those is to sell. People get scared quickly. But it is encouraging to see this. If you go out long enough, things get resolved in some way, shape, or form, which they will with this one too. They'll get
Mhm,
resolved in some way. And then, we usually what happens is we have a nice market increase after that.
mhm.
Yeah, this chart's a good example of why we like to avoid reactionary selling, and just kind of letting take emotions take on. It's good to have a much more longer term view.
Yeah, definitely, Justin. It's a very good point. This is even traders are getting killed right now because you can't tell on a day-to-day basis what's going to be tweeted out and who's going to say what. And if you're trying to trade and time the market, you're just getting destroyed right now.
Mhm.
Long-term investors, you almost could turn a blind eye to everything that's going on and just let it go, which is really this chart. So if you look at this chart, this goes back to 1928, and there's all these little boxes in here are wars, including World War II in here. So there's a lot of wars. There's 33 of these boxes that are in here over about a 100-year period. So you're talking about once every, what was that, once every 3 years?
Mhm.
Once every 3 years or so, you're going to have some kind of conflict, some kind of war that pops up. And yeah, there's going to be these little blip downs, but at the end of the day, the chart goes up and to the right, which means it's increasing over time. And why is that, Justin?
I'm sorry, what was that?
Why is the market over time going up?
Corporate earnings.
Yeah, yeah. So corporate earnings. So you look at our country and just take Apple, the company Apple for a minute. Most everybody's got an iPhone or some kind of phone. And if you believe in Apple and you believe they're going to sell more stuff to people, more phones and more services, then you want to buy Apple stock if you think they're going to do well over time and make more money as a company. So the stock market, this line right here, if you're looking at the S&P 500, which is 500 companies, it's just a combination of all those companies. If you think in the combination of those companies that over time those companies will make more money, that they'll be selling more things to people, then their stock prices go up. So you kind of look past some of these short term, again, these wars and these things that happen. They're scary when they happen, but if you just have enough time and patience, again, the markets recover and go up. Speaking of corporate earnings, that's this next chart that we have. The question is, well, first of all, 2026 earnings estimates for the S&P 500 are close to 14% growth year over year, which is a very large increase, by the way. It's about twice what the average would be over time. So companies are still expected to be making money, this year, and twice what the average would be. So things look very good. And like we said, if earnings are going up, then that's usually what's called the mother's milk of stocks. It's going to mean stock prices will go up over time also. Interesting with some of the categories, and I'm glad we made some of the moves, Justin, that we did with our ETF portfolio. Because if you look at some of in the orange columns right here, the difference between 2025 earnings and 2026 earnings estimates, you see some wild swings in here. But we're overweight right now in energy, which last year energy had a -8% earnings, and it's going to turn positive this year. So that's a big difference. Some of the other ones in here that have big differences, materials, which are metals and mining, goes from 7% earnings to 23% if that works out in 26 that way. So, we want to be overweighted in these sectors that are estimated to have bigger earnings growth in 2026.
Be interesting to see what that number ends up in on the energy side. These numbers go back to February.
Right.
So
Yeah.
it'll be interesting to see what the energy numbers actually look like. If you
Yeah.
filled
That's
up your car recently, you've seen it.
Yeah, that's a really good point, Brad. This is at the end, near the end of February, these numbers. Depending what happens with the war, if this war does drag on a bit and the Strait of Hormuz is closed, and it's pushing up energy prices, then yeah, you're going to see this. You'll see the earnings estimate go up for sure,
Mhm.
which is good that we're overweight in the energy. Looking at what's going on, wars that are going on, which tariffs that are going on, these kind of things are all part of what we look at as a longer trend of deglobalization. And if you watch our videos, we've had these pictures in here before to on the screen. That's President Ronald Reagan and the one at the top. And that goes back to 1987 when he was speaking in Berlin and he told Mikhail Gorbachev, who was the president of Russia or Soviet Union actually at the time, which Soviet Union was communist back then, tear down this wall. And there was a big wall that was in Berlin that was separating out the communist side, which was East Berlin, and the free side that was West Berlin. And they did. They actually did. Soviet Union ended up falling after that. And they actually literally, you watch videos, you can get on and watch YouTube and watch videos of them taking sledgehammers and smashing the wall down. But that kicked off a 30-year cycle of globalization, where countries were working more closely together, tariff levels dropped, and trade picked up around the world. And when countries are making money off each other, the odds of having some significant kind of conflict going on is drops. So that was going on. And then starting, really in Trump's first administration, when he started talking about, let's build a wall, let's start building walls, building walls in Mexico. That was the first place he started talking about that. And again, there's pros and cons of both these. We're not criticizing one way or another necessarily, but when we're looking at cycles, and if we're in this deglobalization cycle right now, which we think we are, and it could last for decades, then we want to be looking at different kind of sectors to invest in for our clients.
Mhm.
So interesting, the charts on the right side over here. Tariff levels. At one time we had very, very high tariff levels. This goes back to 1890. We had tariff levels even higher than we have today, but we've not had tariff levels for a long time at the levels we have them today. And this chart, I think, says, what does this say in here, Justin? 22%?
22% average effective tariff.
22% on average. I think we ended up not being there. I think we're about 15%, but still
Mhm.
15% tariffs. That's the first time since go back to the 1940s that we've had levels like that. So, and again, there's pros and cons with that. Obviously, the pro is that we're generating revenue, right? And we are. I think our tariff revenue in this country this year is estimated to be three times what it was last year. So we are raising revenue that way. The downside is what are some of the downside of having tariffs and bringing manufacturing back home and onshoring? What are some of the downsides of that happening?
It
Pricing's
could,
going to increase.
Yeah. And Brad, you said the same thing?
yeah, it certainly can definitely increase prices. Um, a lot of products can be made at lower cost in other countries. So by definition, if you're removing that competition, that you're gonna increase prices.
Yeah, for sure. Here's my iPhone. There's no way this phone would not be a lot more expensive if we were trying to make all these parts and pieces in here, because
I,
most of
I
the
think
stuff is made in China or India or somewhere, right? Where wages are much lower and the price of the phone is reasonably enough price that people can buy it. If it was $3,000 or $4,000 for this phone, Apple would never be able to sell these phones, not in the mass quantity they did.
no.
So
I just bought a new we just bought new phones, and I think the price of the new iPhones that we got was something like $1,200 or something like that. I've seen estimates that if you made that phone in the United States, it would cost well over $5,000.
yeah, there you go.
It's incredible.
Yeah, it changes things a lot. So, but yet, if you're bringing manufacturing back home, you're helping our workforce because
Mhm.
now you got more people, more opportunity for job at higher wages, and you're protecting yourselves a little bit more. Because what if China decides they're not going to, they're refusing to make the phones, make the components for the phones? So there's positives again and negatives, and we got to look at all those and kind of figure out what that means for investment purposes. The other thing that's happening, by the way, that's chart down the bottom is defense spending for the first time in many, many years, many decades, is going up in non-US countries. So we've been essentially ramping up our defense spending for quite some time. But the European Union, even Japan, all around the globe, not China, China's been ramping up their spending too. But besides the US and China, most countries really ramped down their defense spending over the last number of decades, really going back. And you see this chart down here that the European Union now is starting to ramp up their spending. I saw NATO, Justin. How many countries are in NATO?
32.
There's 32 countries in NATO, and the one I don't have it here on the screen, but I had this in a chart that, before just recently, the
Mhm.
target spending on defense for those 32 countries on average was 2%. So NATO essentially told those 32 countries, which are free countries, a lot of them in Europe and other places, that you should be spending 2% of your economy on defense spending. And they just recently ramped that up to five, increased it to 5%, which is a huge increase.
It's
But
150%.
yeah, it's a massive increase, and you're seeing it happening. And part of that's some of these countries, the trust is not quite as strong as it used to be that the U.S. necessarily has their back. And, the positive with this, I think, is that maybe they should be spending some more money on their defense. Why should they be relying on the U.S. to defend them all the time? So that's a positive. Another reason that's supporting our case for international investing, by the way, for foreign investing, because if these countries are spending more on their domestic economies in the defense area and other places, it's just going to help their corporations and make their stock market go up. So it's another reason why we have overweighted to international. And then that's our take on what's going on. So I would say the bottom line for us is if you're a long-term investor, it can get scary. The events that happen like we're in right now, and every day there's a new headline, they're threatening, they're dropping bombs. It is scary. But if you're a longer term investor, and longer term meaning if you're, what would you say longer term means to you, Justin, with your clients?
For the 7, 8 years plus,
Yeah.
maybe
So,
maybe five
somewhere,
plus even. Yeah.
yeah, somewhere in that range. It's not as long as it used to be.
Right.
When I started in the business, long term was like 20 years.
Mhm.
Now everything's kind of scaled back. But yeah, so if you're 5 years out or longer, the odds of this being resolved within the next 5 years are like probably 99%.
Right.
So it's very, very high. We can never say 100%, but certainly very high. When that happens, the charts show that we showed you before that, things do recover, the markets recover, the economy recovers, those kind of things. So long-term investors are just perfectly fine as long as you think the US is going to continue and other countries are going to continue to grow over time. Any other last comments you guys have?
I don't have anything.
Brad?
I would just add one comment. The chart that showed the market going back to the 20s. Many of my clients know that uh, in my office I have a very similar chart,
Mm-hmm.
and I use that chart. And I always tell them I'll point to the chart and I'll say when we have one of these dips, and we will. That's just how markets work. Remember this chart. And it's a little bit different because it doesn't just show the wars, but it's something good to remember that you'll have good times, you'll have bad times, but all in all, as Justin said, ultimately earnings drive stock prices, and the earnings will be there. We may have blips, but it'll be there, and the markets will rebound.
Mm-hmm. And last thing my last comment for me would be, if we've been talking about long-term and long-term investors, if you're a shorter-term investor, which some of our clients are, on my list of servicing clients, I think I have five, and I'll have my dad's turning 90 in May, and he'll be my sixth client in their 90s that I have. I don't have one that's 100 years old yet. My dad says he's going to be the one, so we'll see. But if you are older and the time horizon is not as long, then yeah, we do need to be a little careful. And if we have done our job, then we've structured your portfolio in a way that's not going to get hurt too bad if there is these adjustments that happen along the way. All right, well, thanks for watching and listening if you're listening to it, and we will see you again.
Bye, everybody.
Thank you.